People are reporting on every major news platform that the Federal Reserve will be cutting interest rates both this year and next. But what does that actually mean for buyers and sellers in Manhattan for these first few months of 2024?
After all, national housing trends have very little to do with what's happening here in the city. But without a good resource that's specific to what we're seeing in the neighborhoods where we work every single day, Manhattanites are left wondering what to do. I'm John Gasdaska.
And I'm Jonathan Conlon, and as expert real estate brokers in New York City, that's what we're here to change. Until interest rates have leveled off for a while, we're going to be giving you quarterly updates on where things stand and what interest rate changes mean for those that call Manhattan home.
Before we jump into advice for buyers and sellers in Manhattan, we do need to talk a little bit more in detail about what's happening with interest rates. In 2023, the 30-year fixed-rate mortgage started at about 6.5% in January, climbed to around 7.75% in late October, and then fell back down to 6.6% by the end of the year. What's happening?
Rates have already fallen pretty significantly from their peak, but we do expect them to keep going. The Federal Reserve released statements in late 2023 saying that they will not continue rate hikes in the near future, and in fact, are prepared to cut rates several times starting in late 2024 and into 2025, as long as things continue to go in the direction they're heading.
That does depend on a lot of economic factors that we're not covering in the scope of this video. But if inflation continues to slow down, job growth continues to be healthy, and if in fact we do pull off the soft landing that everyone has been talking about, lower interest rates are to be expected in the near future.
When will the Federal Reserve cut rates, though? It's really hard to say, and that's a question that even top economists can't agree on. In this video, we're going to be focusing less on timing and more on what to do with the information that we have right now. After all, transacting on New York City real estate based on speculation is a recipe for disaster.
So let's discuss what's happening in detail and the impact that it will have on your Manhattan home, whether you intend to buy, sell, refinance, or stay in the same place.
Buying an apartment in Manhattan is incredibly expensive compared to the rest of the country, especially felt by first-time buyers. Not only are the list prices well above the national average, but building-imposed requirements on post-purchase liquidity and minimum down payments in co-op buildings, as well as the lack of renovated inventory we've been seeing recently, means first-time buyers in the city often feel like they're in an uphill battle.
If you've been wanting to buy and you have your down payment and post-purchase cash saved up, but are priced out due to the cost of debt, you can certainly keep saving and just hold on. Based on what we're seeing, rates will eventually fall. But I do have to warn you that there is a lot of pent-up demand right now in our market.
And when rates do fall, all of the buyers that have been waiting in the wings will come to the market. Of course, some of them will be sellers that have been wanting to trade up or down, but have felt locked into their current apartments due to interest rates. But we expect a much more common profile to be first-time buyers. Our reasoning for that conclusion is that renters that have been watching the market since early 2022 until now have been either reluctant or unable to enter the market because rates have been trending upward during that time period.
Just how hard has it been? Well, let's take a look at some numbers. In Q4 of 2021, the median price in Manhattan was $1.2 million, and the interest rates were about 3%. Let's say the monthly building fees are $1,500, and you put down 25%. That puts the monthly payment at about $7,400. If we take a look at that exact same scenario, but at 6.5% interest rates, you're looking at about $9,200 a month.
Now that's a difference of $1,800 every single month. And while wage growth has been strong across the economy as a whole during this most recent inflationary period, white-collar workers have been hit with sudden and widespread layoffs over the past few years, which for many has eroded their tolerance for less pleasant financial decisions like purchasing at a higher rate.
So what does all that mean? Well, many of the first-time buyers that would have normally transacted between 2022 and now, early 2024, have simply been waiting to buy until rates come down. When they do come down to a more tolerable level and first-time buyers feel more secure in their jobs, we are confident that we'll see a pretty big surge in this category.
And more buyers means more competition. Competition only does one thing to prices. They increase. So later this year, while we are all expecting the cost of debt will be lower, the increased competition will cause list prices for apartments to go up. That's why our best advice right now for first-time buyers is to be open to purchasing something that might need some work at a lower price rather than waiting for rates to fall.
And here's why. Even if first-time buyers were able and willing to handle the financial implications of higher interest rates, it's just hard to find move-in ready homes these days. The sellers that are out there right now must have a pretty compelling reason to sell because they know interest rates are keeping a lot of their potential buyers on the sidelines. So why do they sell? Well, it could be an estate sale. They need to move for health reasons, divorce, they might lose their job, etc. But what we're finding is that a lot of the apartments on the market right now need a fair amount of work. And apartments that need work are priced lower. If you aren't afraid of a renovation, there are definitely apartments available that might fit into the first-time buyers' budgets, even with higher interest rates.
In other words, if the only thing keeping you away from buying are the cost of debt and the inability to find the apartment of your dreams in your price range, with some flexibility in your expectations, you might be able to come out on top if you're able to stomach the process of renovating. In the end, you will end up with a great apartment that's customized to your taste and get in before the inevitable increase in competition that we expect to see, and therefore higher prices.
And while your interest rate will initially be higher than if you waited, you can always refinance, making this one of the most attractive times to buy a home in Manhattan.
Okay, so now let's talk about current Manhattan owners. There's a huge divide between people that finance at 4, 5, and 6% and those that were lucky enough to finance at 3 or 4%. Because rates haven't fallen dramatically yet, it's obvious that it would be a poor financial decision to trade a historically low interest rate like 3 to 4% for what we're seeing on the market today, if your property still suits your needs.
If you're a potential seller who also wants to buy and you have one of those record low interest rates below 4%, it's going to be a really tough financial decision for you to leave your apartment. We understand that if you can tolerate staying where you are, it's a once-in-a-lifetime financial opportunity to have access to such inexpensive money. If you really need to move, then we'll help you sell and find your next place. But because we always have our clients' best interests at heart, whether that helps our bottom line or not, we understand that you will probably want to stay if you can. There's a reason that inventory in Manhattan declined 2% year over year and 1% quarter over quarter in Q4 of 2023, despite rates falling almost a full percent. And it's because they just aren't low enough to have it make sense for many sellers to make a move.
If you happen to have a rate around or above 5%, most likely due to an adjustable rate mortgage exiting its initial fixed rate period, which will be better explained in an upcoming video, then our advice is a little different. If you're feeling like a different space would serve you better and you specifically have a renovated home in a desirable area, then consider coming to market sooner rather than later. While Manhattan's market overall has been depressed for a while now, there is a serious lack of renovated inventory out there, and renovated apartments are trading quickly, sometimes even with multiple offers.
So let's say you've successfully listed your home and it's closed. Now you have to find another place to live. As we mentioned before, you're faced with little renovated inventory and a lot of apartments which need work. If you're set on moving into an apartment that doesn't need renovations, you're going to face a lot of competition from other buyers since there's just not a lot of inventory like that out in this market right now. But if you're willing to buy a place that does need a little TLC and update it, you're getting the best of both worlds. Selling an in-demand apartment at a higher price and buying one that needs a little bit of work at a lower price. And most of the time, we're not talking about large renovations. Painting the walls, replacing the floors, maybe updating cabinets. They can make a huge difference of how your home looks and feels.
As a last grouping, if you're a potential seller in that 5% plus category with an apartment that does need some work, consider reaching out. While it might be better to wait for rates to come down, therefore increasing the buyer pool and driving up competition for your home, sometimes that just isn't possible with your life circumstances. It's not always a gut renovation that an apartment needs in order to market it well. Sometimes it's paint, decluttering, cleaning, staging, etc., which are all things that our team is incredibly adept at advising on. Just give us a call.
So we've covered potential sellers who are also wanting to buy, but what about those of you that love your apartment but just aren't happy with your rate?
It's pretty much impossible to time the market perfectly, so basing a refinancing decision solely on when you think rates are going to be the lowest is probably not the best idea. Sure, we would suggest waiting a few months into 2024 to see what happens with rates, but you should really take other factors into consideration too.
For example, if you also want to shorten your loan term, you need to change your loan type. You need to tap into the equity for whatever reason, etc. Those are all reasons that people might want to refinance before rates hit bottom.
On the other hand, if you're planning on selling in the next few years, you're close to paying off your existing loan, or your credit score isn't where you want it to be, you should probably keep your existing mortgage and not refinance. After all, we're likely looking at a new normal of rates for the next few years around 4 to 5%, which is still historically low, especially compared to the rates we saw in the 80s and 90s.
But let's say you don't have any of those considerations weighing on your decision. You want to keep the same loan terms. You're in a similar place financially as when you took out the loan. You don't need to tap into your equity, and you have plenty of time left before you'll have to pay it off. What do you do then? Well, just pay really close attention to what the Federal Reserve is doing, as well as current rates. They often jump up and down slightly over time, but when you see a shift in those trends going upwards instead of down, be ready to act.
So let's say that you're a homeowner in Manhattan with no intention of selling and you were lucky enough to get a great interest rate, so you don't need to refinance. You love your home and you plan to live out your days there, but you're still curious about what's going to happen to the value of your home over the next few months and with all we've been hearing in the news.
Well, Manhattan has historically seen a good rate of return each year. Sure, there are outlier years like 2020 till today, but if you hold on for long term, you're going to be just fine. In fact, the pressure put on the market due to the increase in demand from buyers who have been on the sidelines that we expect to see later in the year as rates drop means that it will probably be a good year for you in terms of appreciation.
There's one last scenario that we want to cover, and that's the fear that all of the sellers with renovated homes that have just been waiting for rates to fall enough to make trading make sense will list, both flooding the market with a ton of inventory and further increasing the number of buyers. Could there be a debilitating number of buyers compared to inventory once we add together the pent-up demand of first-time buyers and sellers that want to trade up or down?
Well, in short, no. Here's the thing. We need to remember that interest rates increase significantly over a short window of time. So most mortgaged homeowners have a rate well below where the rates are sitting currently. In other words, we are talking about a relatively small fraction of sellers who either have a very significant reason to sell in such a short span of time, which would mean they are less concerned with a potential loss, or they took advantage of an adjustable rate mortgage product when they purchased and it has now entered that adjustment period. If you're not sure what an adjustable rate mortgage is, or you happen to have one and want more specific advice, we'll have a video coming out shortly to dive deeper into that subject, so be sure to subscribe. But first, we need to talk about how we expect interest rates to fall.
Economics as a whole and interest rates themselves are not often things that change dramatically overnight. So while we do expect rates to fall, it's going to be a gradual process. Look at it from the Fed's perspective. If they were to suddenly drop rates, inflation would soar, which is exactly what they've been trying to avoid for the last several years. It would essentially be undoing all of the work they just did. A more logical scenario would be that as rates gradually drop, more and more sellers at lower rates will enter the market. But it's not going to be a fire sale situation.
So that's a ton of information. And if you just want a quick and easy takeaway, we're happy to give that, right?
If you're a first-time buyer and want to avoid competing against all the pent-up demand we expect to see come to market later this year, consider purchasing an apartment that needs some work at a lower price now rather than waiting.
If you're a seller who wants to trade, but you're lucky enough to have a record low interest rate that you simply can't walk away from, you're probably best staying where you are. If and when you need to move, give us a call. We'll work to make sure that you get the best outcome possible.
If you're a seller that wants to trade with an existing rate that is similar to the current rates, and you have a renovated home, we urge you to come to market sooner rather than later. There's a serious lack of renovated inventory out there, and you'll probably transact quickly. Just know that while a lack of renovated inventory is a great thing for you as a seller, as a buyer, it might force you into purchasing a home that needs a little more work. You might get lucky and find something that is move-in ready, but there's so few and far between these days that you also might not, or face competition with other buyers to secure it.
And if you're a seller who wants to trade with an existing rate that is similar to the current rates, and you have an apartment that does need some work, give us a call. We can help you put your best foot forward so that you stand out against the inventory that's out there these days, right?
If you love your home and want to refinance, be sure to weigh both current interest rates and if you might want to change something about your loan before making your decision.
Lastly, if you just want to know how the economics of interest rates, supply, and demand are going to affect the value of your apartment, know that it's probably going to be a pretty good year.
Whether you're a potential first-time buyer trying to figure out how to get into Manhattan's real estate market, are a current homeowner that wants to trade but isn't quite sure how, or you just need more personalized information and analysis that a video like this can't provide, we strongly recommend reaching out to licensed professionals
Like us.
to navigate the complexities and ensure you make the best informed decision for your unique situation.
I'm John Gasdaska,
And I'm Jonathan Conlon.
and we look forward to meeting you.
We do.